Hello and thank you for clicking on the video. This is the second video in the book summary series of The Intelligent Investor, where I will highlight some of the key concepts and ideas from the book chapter by chapter that I think everyone should read or at least know about. The goal of this book by Graham is to provide a framework and mindset to approach researching and analyzing companies through, from which the investor can begin to develop an understanding of the underlying value of the business to make an investment decision on. So let's kick this off with chapter 2, where Graham discusses a topic very applicable to the environment we are in today, how an investor should approach, think about, and invest accounting for inflation. This chapter kicks off with a simple definition and contextualization of the concept of inflation. As investors, we need to understand what inflation is and how it not only impacts our returns, but our purchasing power too. With how much inflation and its impacts have been on the public's mind in the recent year, it is very important to understand just what inflation and its implications are. Graham frames inflation in the book as simply the shrinkage in purchasing power of past dollars and the expectation that there will be continued future declines of purchasing power in the future. In common terms, this means that a dollar tomorrow will buy you less than the same dollar would today, or in other words, the value of your dollar has been reduced. As investors, we hope to offset inflation through holding bonds and equities on the expectation that the loss in a dollar's purchasing power may be offset by interest payments, increases in dividend payments, or the increase in the prices of the holdings we have. One key thing to remember when it comes to inflation is the trap of what can be described as the money illusion, and it is one of those more important things an investor must be cognizant of when dealing with inflation. The money illusion is the misperception or false feeling of advances in pay or returns due to the investor or individual only considering it in nominal, not real terms. For example, if you receive a 2% raise in a year when inflation runs at 4%, you will likely feel better than if you take a 2% pay cut in a year when inflation runs at 0%. However, both changes leave you in an identical position of being 2% behind the rate of inflation. So long as the nominal or absolute change is positive, we as investors are likely to feel better and see it as a good thing, even if the real or after inflation result is negative. And this here is the money illusion. This so-called money illusion is why Graham suggests that the intelligent investor is one that will always measure their anticipated returns from an investment or the success of a past investment return in real terms, not nominal. By considering investments in real terms or after inflation, the intelligent investor can be better guarded against what is unexpected or underestimated. To relate this back to today, we consider how the nominal rates of bonds have increased around 4% on the Treasury, or for other Canadians out there, we can see some GIC rates at 5%. However, the intelligent investor would recognize that, with inflation having recently been near 7%, the expected returns on these investments would yield a negative real return. Thus, an intelligent investor who is aware of the role of inflation and its influences on the returns generated by an investment vehicle or opportunity, they would know how to consider looking elsewhere to be able to create real returns. This then begs the question, what can the intelligent investor do to guard their portfolios against inflation? Based on the example just made with bonds, the obvious answer we may think about is to simply buy stocks. While true in part, it is not the full story, as if we go back as far as we can since the stock market performance data was first made publicly available, 1926, we see that the broad market only outpaced inflation about 80% of the time for a given 5-year period. This means that a given 5-year period, there was about 1 in 5 chance that stocks as a whole would underperform inflation in terms of real returns. So how do we as intelligent investors deal with this imperfect scenario in our battle against inflation? One alternative an investor might think to consider is the purchase and holding of gold as a hedge against inflation in their portfolio. Oddly enough though, Graham does not make gold a recommendation as a means to help guard against inflation. Why? Graham points out that in the first 35 years of being available on the market, from 1935 to 1972 at his time of writing, gold had only seen a 35% rise from about $35 an ounce to $45 an ounce, while producing no cash flows along the way. For this reason, he does not suggest investors to dedicate attention to gold as a means to guard against inflation. The next option we may think about is real estate as a guard against and to keep up with inflation. While it is true that real estate offers an effective way to guard against inflation, Graham does not recommend it to the average investor as a first alternative for 2 main reasons. Real estate prices are subject to wider fluctuations, and there is room for exceptional error in things such as location and price paid. So then, if gold is out of the question and real estate an apprehensive recommendation, what can we get from Graham in terms of how to guard against inflation? If the stock market as a whole can be expected to have periods of lackluster or negative real returns, Graham's most consistent recommendation is to recognize other opportunities to purchase undervalued companies that have the potential to produce higher returns than the market as a whole. To take a specific passage from a chapter where Graham discusses this point, We have no enthusiasm for common stocks at these levels. For reasons already given, we feel that the defensive investor cannot afford to be without an appreciable portion of common stock in his portfolio, even if we regard them as lesser of two evils. The takeaway from this passage is that the recommendation is for the intelligent investor to still seek to acquire equities. But in environments where buying the index may be a situation of excess risk for limited real returns, to instead focus their attention on finding companies or sectors that may seem to be undervalued and have less risk for greater potential return. Then when the index becomes a vehicle of adequate opportunity for risk incurred again, to reevaluate and consider holding it as such the passive investor would do. In the modern day, we as investors have access to investment vehicles that simply did not exist at the time of Graham's writing, and offer an opportunity for us as intelligent investors to consider to guard against inflation. First, we have REITs or real estate investment trusts, which are holding companies that own and collect rent from a portfolio of properties that they then distribute as a dividend. These new vehicles offer an opportunity to gain exposure to real estate as a means to combat inflation to investors. The catch with REITs, though, still harken back to Graham's caution around buying real estate directly. The REIT companies that purchase and hold the property are subject to the same pitfalls, and the investor can end up with a REIT that holds a basket of poor real estate properties, unable to generate adequate or stable returns. The other investment opportunity available to the modern intelligent investor and to consider are TIPS or Treasury inflation protected securities. These TIPS are U.S. government-issued bonds that automatically go up in value when inflation rises, or more bluntly, they keep pace with the rate of inflation. Since these bonds are backed by the faith and credit of the U.S. government, the risk of default on them is very low. There is one catch though with TIPS that investors need to be aware of. When the value of the investor's TIPS holdings increases with the rate of inflation, this is regarded as taxable income in the eyes of the Internal Revenue Service or IRS. This means that while the value of your TIPS are increasing so as to not lose out to inflation directly, you will still be losing out to inflation through the taxes to be paid on the increasing value. When it comes to being an intelligent investor and considering inflation, the first battle that must be recognized and made is the psychological one against the money illusion. The intelligent investor must learn to think of returns in real terms, not nominal, to be able to make the best and most effective investment decision when it comes to choosing what to invest in. Once the investor has learned to think in real terms, they can then proceed to adequately guard themselves against the never-ending battle with inflation. To guard against inflation, the investor consider a variety of vehicles such as gold, real estate, TIPS, and equities. But even with these alternatives to equities available, Graham still suggests that his preference is to lean on equities, and in instances when the broader stock market may be looking to underperform inflation, seek to find individual equities or sectors that may be undervalued. Of course, Graham's approach to investing is not 100% applicable to all investors, but it is the principles that are important to take away, consider, and apply to your own investing mindset, as everyone is different in terms of their situation and goals. Part of being an intelligent investor is to consider and recognize the different investment opportunities available to you and what you are comfortable in understanding and your own expertise. That concludes the summary of Chapter 2 of The Intelligent Investor, and if you got some value from this video, or it helped you better understand how to think about investing and inflation, please hit that thumbs up button and consider investing in that subscribe button too.